Hey everybody, welcome to another week calling all investors. We are live with Caeli. Today, September 27th, 2022. Every Tuesday we meet here on Tuesdays at 4:30 p.m. Eastern, 1:30 p.m. Pacific. And as always, if you have any questions about the show and about anything that we cover, feel free to give Ridge Lending Group a phone call at 855-74-RIDGE, or you can email them over to info@ridgelendinggroup.com. Today's a very special day. We've got a very special guest. So without further ado, Caeli Ridge, let us know what's going on here.
Thank you, Larry. Hi, everybody. Thank you for joining us. I know I've been plugging this for a couple weeks. I'm so excited that the day has finally come. I think you guys are really going to get a lot out of this. I'm very excited to introduce you all to our colleague and friend and client, Ashish, our investor-friendly CPA. I've got a background I want to read to you guys real quick, and then I'm just going to turn it over to him. He's got a presentation that he's going to have for us today, go through it. I know there's going to be a lot of questions. Larry's going to kind of police that and keep us on track. So feel free, like you said, to plug those in. This is going to be freaking cool. So thanks again for joining us. Let me just quickly, there's some really good intel here. I'm just going to read through Ash's background. He began his career at Ernst & Young, a Big Four accounting firm in Atlanta, where he worked on multiple private and publicly traded Fortune 500 companies. During his tax and accounting consultation roles, Ash developed a deep understanding of various complicated tax issues, tax planning opportunities, and tax-efficient real estate acquisitions. Early on, Ashish understood that most of the small businesses, unlike large businesses, don't have access to good CPAs. Ash founded his firm to fill that void and now serves a select number of clients who have entrusted their finances with him. Together with his strategic team, he helps clients address their biggest concerns, of course, which is mitigating taxes and preserving their wealth. He's helped countless small businesses with extremely valuable tax plannings. He uses a consultative process to gain a detailed understanding, and this is the part that I found really unique about his bio, and I loved this, Ash. He uses consultative process to gain detailed understanding of his clients' deepest values and goals. He then employs customized recommendations designed to address each client's unique needs and goals beyond simply preparing tax returns. And this is so aligned with what Ridge does, right? It's holistic, it's individual. I love that part of it. In his engagement model, a client becomes the CEO of the client's financial life, and Ashish becomes the client's personal CFO. He deciphers complicated financial and tax information and delivers insight that leads to smart financial decisions. Viewing your business from the perspective of a growth-conscious CPA should enable your business to act on the insights, opportunities, or problems revealed by the data they occur. He also, by the way, as I've been telling you guys, is a real estate investor who understands, and this is what makes him most unique, who understands from the underwriting perspective, right? We've talked about this so many times on our Tuesday community events where us as a lender, Ridge Lending as a lender, we focus on investors' needs, but I am an investor. So I have both of those lenses. I can see it from both perspectives. Likewise, you're going to find that Ash and his team, being CPAs, focusing on real estate investors, have that lens too. They are investors themselves. And he and I have worked very, very closely together over the years. So understanding the underwriting component of this is huge, and I think you're going to love it. So Ashish, without further ado, I'm going to allow you to take it away. Let's do this.
Let's do this. Who's that?
That was background noise. For everybody, please put yourself on mute. Ashish, that was your drum roll, in case you didn't notice that one.
There you go. No, I love it. People are already excited to talk about taxes, and I hear I don't know. I'm gonna make this investors all sleep today, but we'll try to make this very high level and very, very actionable. And I have prepared a few things that, if time permits, I want to give you some numbers that you guys want to focus on. But my whole goal today is to teach you guys, when you should be doing cost segregation. Okay, that's the gist of this conversation, because I get clients, new clients left and right every single day, and they will come to me and say, I did cost segregation, I'm going to save hundreds of thousands of dollars in taxes, and they don't. And I want to make sure, which if you plan it correctly, you can save hundreds. I mean, I had a call right before this webinar, and this one of my clients saved $350,000 in taxes, 2021, which we just filed, and he thought it was a scam, which is not. So I'm going to show you how to do that, and then maybe, you know, again, if time permits, I'm going to show you some numbers. So today we're going to talk about cost segregation, what it is, why it's important, especially in real estate, and how to use it. And depending on what you are and which investing level you are, or what you do as an investor, how can you save taxes with cost segregation and real estate, for that matter. That's what we're going to talk about. I know you guys are going to have a lot of questions, so I will answer them maybe after each segment or at the end. So again, just so you guys know, this is it gets very complicated. I'll try to make this very simple. If you have questions specific to your situation, that you should be taking that to your CPA. So whatever you learn today, make sure you just say, hey, why have we not done this? Or I heard about this, can we implement this? Because we don't want to implement any strategies in this call, because I'm not allowed to, because we're not even engaged. I'm just giving out information right now, okay? So with that said, I'm going to share my screen. It's not, let's see if you guys can follow what I'm going to share. I'll be looking at the other screen here. So when Caeli said we as a firm focus on tax planning, that's what we do. We don't even have a client, we just do tax return. Throughout the year, we do tax planning, and this file is what we use, our proprietary file to talk to clients, saying, hey, what happens if you have corporations or not, all the deductions you can take, and at every single level. But what I've done today is I've created kind of this question and answer format where we can go and talk about some of the questions. And I wrote it's very informal. I just created this for the call. So I want to go through this and see if I can clarify a few things for you, okay? First thing is cost segregation. But even before talking about what cost segregation is, which most of you might already know, I want to tell you guys why it's important, what we're trying to do with cost segregation. Because if you don't understand that, everything is useless. So our goal as a real estate investor, I'm an investor myself, and what I'm trying to tell you guys is this: people invest in real estate for a long-term wealth building strategy, and everyone knows that, right? However, what I help people, and what you guys should be focusing on, is how can you build your long-term wealth with real estate while paying zero taxes? That should be your goal, because that's how the wealth multiplies. Any lawmaker, okay, it doesn't matter which party it is, Biden, Trump, any in Congress, they do this day in and day out, and that's how they're saving money, and that's why this is so favorable to investors. So first thing we're going to talk about is, why are we even doing? What is even cost segregation, and why is it useful, and why do we need to do that? So if you can see my screen. You can see my Excel, right?
Yeah, you're all good, Ashish. Go ahead and keep on going.
Okay. So what we are trying to do is this, okay? We have two types of income. We have non-passive income, which is this, in this area, and we have passive income and losses. Our goal is how to offset our W-2 income, 1099 that you guys make as a realtor, or any other, like a doctors makes 1099, any other business you guys have. Doesn't matter what business. You can be 100% owner of a multi-billion-dollar company, any kind of business you have, any short-term rental income that you manage yourself, or any flipping, wholesaling, realtor, construction, doesn't matter. Any kind of business you're actively involved is non-passive income. So our end goal is this. It's very easy. How to harness our losses from rental real estate, okay, or other, passive businesses or short-term rental, move that to this bucket so they can offset each other. It's that simple. Normally you cannot, okay? That's how the law works. let's say give a quick example. Let's say a doctor makes $1 million a year. He cannot go buy real estate and save taxes. It never happens. He cannot offset his $1 million practice income or W-2 income from a hospital with the real estate. But we should be planning to do that. And that's what I'm trying to tell you. Our end goal is to move our passive losses that we're going to harness from this passive bucket to non-passive bucket. That's the end goal. And everything we're going to talk about is what makes that happen today. Okay, that's the end goal, but let's see how to make that happen. So why do we do cost segregation? For the exact same reason, to offset your W-2, your capital gain, your crypto gain, I don't know, your any kind of income you have with real estate. So that's why we're doing this. Okay. Now, if you understand that, I'm going to hide this and I'm going to open up next part of this. And this is kind of visual. If you guys are visual, I just wanted to have this, in your screen, right? All we are trying to do is take non-passive income, which is your W-2 and stuff, let's say $400,000. Or let's say you have another capital gain of a stock trading game, a Dodgers gain that people had the last year, $100,000. That together is is $550,000. If we can have a loss from real estate with cost segregation, which is $350,000, it takes your taxable income from $650,000 to $200,000. That's a huge tax savings, and I'll give you guys a number later on exactly how the number plays out. But that's what we're trying to do. So the goal is to harness losses with real estate, convert that losses from passive bucket to non-passive bucket, like I told you earlier. We need to convert this to passive to non-passive, and then follow all the rules to offset your non-passive income with passive income. By the way, I saw someone trying to take a picture. I can give this template for you guys, and you can have this PDF after the call. Don't worry about it. Right in the notes. Okay?
Yeah, and as a reminder for everyone, this is being recorded and will be available 100% on video replay on the community later on too, Ashish. So
perfect. Okay, so that's the goal. I hope everyone understands this. All we are trying to do is how can you use real estate and offset your other income? That's how all the millionaires save money. 300, 400, we have said $500,000 a year in taxes for investors. And that's a life-changing money. I mean, that's 10 years, that's a $5 million just by, knowing how it is to happen. At the smaller scale, even saving $20,000 a year, which happens all the time, is $200,000 in 10 years. That's some people don't even have that kind of money in retirement account. So you're basically getting that back from IRS from tax saving. That's all I'm saying, right? So if everyone understands this, let's move on to the next part, and maybe we can take some questions if it gets too confusing. So what I want to talk about next is what is cost segregation and why in real estate? So that's what people ask me, because I'm an investor myself, and people say, why are you investing in real estate? Okay, I understand the wealth building strategy, but from tax savings, why does other business do not give you the same tax saving, right? And you need to defend. And you might be in a different boat than I am, or in other people. I'm a syndicator myself. I buy big commercial properties, and I gather all the investors together, and I have to sell them why real estate, why you invest in real estate rather than go buy Coke, right? So if you have this information, if you're in that route, you can also use this knowledge to sell your syndications or your investments to your friends, family, or partners. So I'm going to give you a very basic example, and I want you to understand this. So the question is, hey, why are we doing cost segregation in real estate and not in other business? Because you can do cost segregation in any other business, but why in real estate? So let's talk about this. I have an example here. If you can see this, it says printer and real estate, right? Let's say you bought a printer for $5,000, and the tax life for printer is 5 years. That's how you can depreciate it, and depreciation is the main key term here, right? When you depreciate the printer, you get to deduct $1,000 each year against your income. It's a good thing, right? At the end of the 5 years, printer goes salvage, you just throw it out. Nothing happens. So let's compare that to real estate. You buy let's say a property for $1 million. The tax life is 39 years for commercial property. Every year you get to depreciate $23,000. Again, same thing as the other one, printer. But at the end of 39 years, let's say you hold all the way to 39 years and you sell this. Unlike printer, the asset actually appreciates, meaning you get to take depreciation of $23,000 every single year, assuming the asset depreciates. But when you sell it for $9 million more. So printer, you just deducted $5,000 over the 5 years, the actual money you lost on the printer because you invested that. But in the real estate, you put $1 million, you take the $1 million deduction, but when you sell it, you basically sell it for $10 million. Again, rough numbers, right? So that's why it's so important that you invest in real estate and then do cost segregation in real estate, because it's a phantom loss. It's not actually a loss. The asset actually appreciates, but you get to take depreciation. Okay, that's the beauty of real estate is. Other assets, restaurant equipment. Let's say you buy a laptop for your business. Yeah, you get to depreciate that too, but you actually lose the asset at the end of 5 years. But real estate, the asset actually appreciates. And the other good news, or not good news, but in a very powerful leverage you have in real estate is 80% of that $1 million comes from bank. It's not even your money, right? Bank gives you 80% loan on your real estate. So you're using someone else's money, which actually appreciates to offset your W-2 income.
So for
That's why.
for just to catch everybody up on, for those that have joined, because we've had a bunch of people join here after the call started. We've got Ashish on. He is a CPA who's also an investor as well. And what we're on right now, we had 5 questions, 5 topics that we're going through. What we're on right now is, why are we doing cost segregation in real estate and not in other businesses? So Ashish, you found, as a CPA, you found, of course, that real estate has a special place in the tax code, and you're helping your clients that you have engagements with figure out what the best way is to leverage that. Is that the best way to say it?
That's exactly correct. That's exactly correct. Why would you use cost segregation? Just because you can do that in any other businesses, but how is it different than other business? And that's what I'm focusing on as we speak right now.
Awesome. So if anyone has any questions, we've got the chats open here. If you feel like you need to talk it through, go ahead and take yourself off mute. The 3 topics that we've covered so far is, what is cost segregation? We've covered why are we using cost segregation as a strategy? And then what we just went over here is, why are we doing cost segregation in real estate and not in other businesses? So if you have any questions on here, go ahead and use the chat or take yourself off mute. And if you're just completely overwhelmed, totally understandable if this is a foreign topic, or if you've been even a shoot away from even thinking about this, we will be taking questions after the show and posting those questions into the community, along with responses from Ashish as soon as he escapes from this hurricane that is barreling down Florida right now as we speak. And we want to say, obviously, to you and everybody in Florida, please take care today and be safe as the storm approaches. So Ashish, you don't have any questions? Oh, actually, we did have a question just right now from Carrillo, or maybe it's Teresa.
Yeah,
so
I see that.
Teresa,
I see that, Larry.
When does it not make sense to do cost segregation?
Yeah, we will talk. We're going to cover that in the next few minutes. So let's hold on to that.
And I'll have a subset answer for that too, guys, because Ashish is going to have his answer to it, but then there's a separate answer that relates to financing. So we're getting there.
There you go.
Perfect. So basically, to summarize, what we just discussed is, hey, how does real estate cost segregation works, and why you should be doing it, and the purpose of you doing it. And someone who just joined, the reason we're doing cost segregation in real estate is to use banks' money to offset your W-2, business income, your crypto gain, your capital gain, anything you can think of from income perspective. Just using real estate to offset that. That's the end goal, and that's what we're doing, right? Okay. Now, I think everyone is in the same page. If not, then again, we'll take questions later on. Let's talk about next step. The next step, what I want to discuss with you guys is this. This was, and with the same question earlier, when it makes sense to do cost segregation, I always get this question saying, hey, let's say, yeah, I do huge cost segregation the first year. What happens to other year? What happens to other tax years? Am I penalized for that? And I just wanted to show this very rough math with you guys. It might make sense later on, but let's, even before that, let me walk through what cost segregation is actually, because we just discussed the front part here saying, hey, why is it different than other business? But I want to give you a very high level definition of what cost segregation is, right? We just discussed $1 million property, 39 years, $23,000 depreciation every single year. But if you look here, with the same property, let's say $1 million property, if you were to do a cost segregation, basically cost segregation basically means you segregate the assets. The $1 million purchase price gets segregated between various classes of asset, which is 5-year property, 15-year property, 7-year property, meaning, you know, appliances, land improvement, or furnitures in your real estate. Those segregated assets can be bonus depreciated. What does bonus depreciation mean? You get to deduct that the first year. Why is it important? Just look at the number here I put together. If you do not, if there's normal real estate over 39 years, you get to take $23,000 every single year as your depreciation, right? But let's say you do a cost segregation on this property and you segregate the asset in this manner, which is again $1 million, but segregated. Now you get to deduct $50,000, $60,000, and $100,000 the first year, meaning the total depreciation is $227,000 versus $23,000 from this amount, right? $23,000. You basically have extra deduction of $200,000 the first year versus $23,000. Now, if you're in the highest tax, let's not highest, but 35% tax bracket, okay, 35% tax bracket is usually someone who makes as a single, you know, $200,000 and up, and married $400,000 and up. Okay, this is the other screen. But let's say you're in that tax bracket. What's happening here? Sorry, I'm in a different tab. There you go, here. So what's happening is the 35% tax bracket, at the marginal tax rate, you're saving $71,000 in taxes just by buying this property. And that's exactly what I'm telling you earlier. Buying a $1 million property, having someone else in a bank give you a loan for, I don't know, $900,000, you're saving $71,000 taxes just at the federal level. I'm not even talking about state tax rate, okay? Again, I know it's a lot of numbers. Don't worry about this. All you need to understand this is what cost segregation is you segregate the assets and bonus depreciate the assets that are, you know, less than 20 years in life, which is basically 15, 7, and 5 most of the time, okay? Now, that gives you huge deduction. Now, if you remember earlier what we discussed is we said our end goal is to transfer passive losses to non-passive income. Where is that loss coming from? That's exactly what I showed you earlier. Here, you have $200,000 extra loss from this real estate, which you would not have in either, you would not have that otherwise if you had not done cost segregation, right? Now you did cost segregation, you have extra $200,000 loss that you would not have this year. You take that $200,000 and boom, you offset your W-2 income and save $50,000 in taxes. Okay, again, rough numbers, but I'll show you exactly how this numbers works in the next few, in this tab later on if we have time. But to recap, that's what cost segregation is. You segregate the asset, hence name cost segregation. That's all. That's what cost segregation is, right? So, but people ask me, hey, it looks like, you know, you're gonna depreciate most, you know, almost $200,000 the first year. Am I gonna penalize other years because you took the huge depreciation the first year, right? So I just wanted to put this in number and show you what is the difference. Look at this. Without bonus depreciation that we discussed earlier, you get to deduct $23,000 every single year. However, if you were to take a bonus depreciation, let's say $200,000, and then now your basis goes down to $700,000, now you still depreciate that over 39 years, you still get to deduct almost $18,000 every year, meaning the difference in depreciation, even after cost segregation every year, is $5,000. With 35% tax rate, that's nothing. And you're losing out on $2,000. $1,500 tax savings every single year, but you're getting $71,000 back the first year, and time value of money. Would you save $1,500 over 39 years or get $71,000 the first year, put that money right back into another property, which can appreciate to $10 million, right? Okay, that's how the real estate works. That's how everyone saves tax. That's how everyone scales up in real estate. You pay zero tax, you get money back from IRS and reinvest so that your property can appreciate. That's how it works. And that's what I did. I mean, and you guys will do the exact same thing if you are not already doing it. Okay, so I just wanted to show you the difference between and basically address the questions that you eventually will get in your head saying, well, we're taking all these deductions the first year. What happens if what happens to other years? Nothing happens. Okay, it's literally in immaterial change in your depreciation to think about. So that's what I wanted to discuss.
Hey, Ashish, will you give
yes.
us the examples again of the different cost segregation, the 5, the 7, just different examples of that again? Because
Absolutely.
you went over that pretty quick.
Okay, let's talk about that then. So let's say you buy this $1 million. Let's stick with single family house because that's what RGL focuses on, right? You buy, and I have a client who buys. I have this client who bought one property in Arizona, $800,000 short-term rental. Off topic, he makes $400,000 net cash flow from that property. I don't know how, but he does it. Insane amount of cash flow. Let's ignore that. But from the property, let's say that was $1 million property, right? If you buy that property and if you do not cost segregate, your depreciation is 23 years every year. Meaning, if you were to net $23,000 revenue or income or rental income from the property, that $23,000 directly offsets that, and you pay 0 taxes, right? You don't pay any taxes in your rental income. But what we're trying to do is go one step further. How can you use your real estate to not only offset your rental income, but go above and beyond and offset your W2 income, right? That's what we're trying to get with cost segregation. So to do that, we do cost segregation. How cost segregation works is you can do this yourself. There's online tools you can do, or you can hire an engineering firm to do this. They'll charge you $2,000 for that $1 million property to do this, but you're setting $71,000, so it is worth it. They will go in there and they will either do virtual or through the pictures, they will segregate the assets that you just bought into various classes of assets. 5-year, 15-year, 7 years. Normally, 7 years is all the furniture. All the furniture you got. If this is a short-term rental, you're gonna furnish it. So all the desks, all the couches and stuff. That's what the short-term rental how it has all this furniture. 7-year property. 15-year is let's say you have a swimming pool on the back, or you have let's say you have a land in a driveway, right? Driveway, or in a backyard pit with a barbecue pit. That's what land improvements are, and that's a 15-year property. And they will segregate that, take it out from your purchase price, and segregate that as the $60,000 goes to your land improvement. And all the appliances, some high-end appliances can go up to $50,000. We're talking about your fridge, hot tubs, and all those things. Together, you can have around $50,000 of appliance. What they're doing is they're going there, they're segregating the assets into different classes of assets, and anything below 20 years, which happens to be this 3, you can bonus depreciate the first year. Does that answer your question, Caeli?
Yeah, I think so. And are those formulas already set? So for those listening, a 5-year, a 7-year, a 15-year, is there a cap? And are those the caps that you're showing us here?
No, it's not a cap. Again, this cost segregation, I'm strictly talking about, let's say, single family house, okay? Right now it's around 27%, 20%. Normally, the cost segregation works this way. And we're going to talk about this number later on, but just so everyone thinks about this, single family house, the percentage that gets segregated is going to be anywhere from 20 to 30%. Again, very rough number, but if you buy $1 million property, on average, you can expect $250,000 of first-year bonus depreciation. It doesn't mean it's going to be only for 5-year property. I mean, that's why we're going to talk about this next. But when you go buy a property, it's an equal property. You want to buy something that has a big driveway because that gives you more bonus depreciation. We can talk about that later on. But what I'm saying is there's not a set number saying, hey, this is capped at this much. This is capped at this much. Sometimes some kind of properties can go up to 50%. I've seen that, and I know this. But
generally, you're saying 20 or 30% of the purchase
single
price.
family, yeah. Okay. But if you were to buy an RV park, 90%, like this $1 million would give you $900,000 deduction the first year, RV park. And I have clients who have $1 million business from their apartment sale, and they'll go buy RV park, offset entire $1 million with one RV park, worth for $1 million. And storage units. Storage units is around 40 to 70%. So they are more even, they can depreciate it more. But let's focus on single family house. You buy a single family house, rental property, doesn't matter how much money you're buying for. It usually makes sense, you go above $350,000 and up. And I'll show you all the calculation later on, how it affects with what kind of purchase price. But there's no set amount or there's no threshold that IRS puts. It's a cost segregation. It's the asset that drives the number, and the engineering firm or you do yourself There's a DIY tools online. You just put the number in there and it spits out this, this number you're seeing on the screen.
Ashish, there are a couple of questions.
Sure.
If you want to take a couple that are some
Perfect.
probably open-ended, and if
Okay.
you want to defer to an answer later, perfectly fine. So the first one is, do you need, Manak asks, don't I need an active income / business in order to take losses from cost segregation or real estate? So that's the first question. Do I need an active income or business?
That's not correct, and we'll answer all of this in the next few minutes.
Okay, great. So the next question is, are there any tips, or do you plan on giving any tips on choosing a firm who provides a quality report per IRS guidelines?
Yeah, they are better firm, but there are so many cost segregation firms. If you could Google them and look at the good reviews, you'll be fine. They defend you on your audit anyway. So you just go with them. It's very mathematical. They have their own model. So it's not like you're gonna lose out on a few things.
Gotcha.
It's not an important point. That's not an important point.
Okay, and this is more of a comment out into the group. Eddie, I see your question as far as when it does not make sense. We've already covered that answer. So I'll point you to that after the call.
So it's just to say we're getting to it, Eddie. We're gonna talk about when it makes sense to do this.
Yeah, we could talk about that. I do see someone saying does all cost active income. We'll talk about that active income in the next few minutes. So yeah, so I think everyone understand what is cost segregation, why it's beneficial in real estate, and what happens after the first year. Okay, that's what we have covered so far. I know it's a lot of information, guys. So we'll talk about this. So next thing is where the meat lies. Okay, this is where all the questions that's coming through. Hey, what do I need to do to take these losses? Great, we understand cost segregation. We understand how it works, and we understand the benefit. You can use losses, but how do you use the losses? So there are 3 ways to use the losses. Very simply, it's very complicated rule. I'm trying to make this very simple for you guys. First way, if a taxpayer, doesn't matter if it's single or married, it's same threshold. If you make around less than 150, then you can take the losses that you harness with cost segregation against your W-2 income or other income. And it doesn't have to be just in business income. It can be W-2 income, and we'll talk about that too. So if you look at my screen, I say that here, make less than $150,000 is the modified adjusted gross income. Applies to whom? Applies to everyone who makes less than $150,000. Cost segregation makes sense. Applies to anyone if you make less than $150,000 a year. Okay, meaning let's say you have $100,000 of W-2 income as a single, young guy, just buy your first property. If you go and do cost segregation on a rental property you just bought, you can offset up to $25,000 of your W-2 income. Only 25. It's not unlimited. That's the exception with that first rule. Other two, there's no threshold, but the first one is up to $25,000. Again, for someone who's making $100,000, that $25,000 is pretty good tax saving. You probably save around $10,000, $15,000 with not 10, maybe $8,000 with that cost segregation. The first way, what I'm trying to get at is, first way is you make less than $150,000 in income, then you can benefit from cost segregation. That's the first way. Last 2 ways are complicated and it gets very technical, but to make it very simple, second way is if you qualify as reps, okay, it's called registered professional status, not a licensing requirement, just an hour requirement. And we'll talk about that later on. If you qualify as reps, then you can have a $500,000 in W-2 income, or you can have a $10 million in business income. You can use a rep status, invest in real estate, offset entire income with a real cost segregation. But you have to qualify as reps. I'll tell you how it applies to husband and spouse and everything later on. But that's the second way. Reps, you need a rep status. Let's say you don't qualify as reps and you make less than $150,000. Then we go to the next step, which is short-term rental. So that's why if you look here, it says applies to whom? First one applies to anyone who makes less than $150,000. Second applies to who qualifies as reps. Okay, that's who qualifies as reps. Now, if it doesn't apply to, if both of them do not apply, then you go to the second one, third one, it says you invest in short-term rental, STR. This applies to anyone. Doesn't matter how much you make, how much business owners are. it applies to everyone. Those are 3 ways. And I will, in the next few minutes, I will tell you exactly when you need a long-term rental and a short-term rental, how it interacts with everything. But we're going to go there. But that's the 3 ways you can use the losses we just harnessed with cost segregation in the next few minutes before. Guys, I know a lot of information. I'll try to make this as simple as possible. What we discussed is, what's the point of doing this? Trying to offset your W-2 income. What is cost segregation? And then once you do cost segregation, you have a huge loss. How to use that loss is what we're talking right now, right? How to use that loss. And how to use that loss is basically these 3 ways. Make less than $150,000, or qualify as reps, or buy short-term rental. Okay, one of the 3 you made, you're fine. I think we're good now. Now, I don't see any questions, but we'll talk about it now. Some of the things that you guys have asked before. So next, again, I'm going to make it very simple. We only have 2 things to discuss next. It's not even that complicated, but it's going to take some explaining to explain this. And after this, I'll give you exactly, hey, if you make this much money, what is your threshold? How much you need to buy to offset the income? We'll talk about that. But let's talk about what's the next topic is this. Which profession do you need to be to use all these losses? First of all, let's talk about that. Or, which kind of investment you need, depending on what you do in your full-time job or investor, to use this cost segregation, all this benefit. Okay. So I'm trying to reach out to as many people as I can, saying, hey, if you do this, if you have a full-time job, if you have a business, or you have business owners, what do you need to do, and how can you do that? That's what I'm showing you right now. So let's talk about this. Let's talk about a couple where one spouse is full-time real estate. If one spouse is full-time real estate, then what we discussed earlier, you can use both the strategies, like what we talked about. Let's see what it is. This one, year 3 and 4 is 2 and 3. If you are full-time real estate, you qualify as reps, and you can also buy short-term rental. And that's exactly what I'm showing you here. Cost segregation applicable. Where is it applicable? It's short-term rental or long-term rental. Both of these works for you. One spouse has to qualify as reps, meaning real estate professional status. Complicated rule, but if you do full-time real estate, you'll qualify. You cannot have W-2 job, or a spouse cannot have W-2 job, right? So requirement, what is the requirement? It's pretty simple. Short-term rental, you have to materially participate in short-term rental. We're not going to go into all the participation rule and everything, but if you have a short-term rental, then you'll be fine. If you have a long-term rental, then you need to qualify as reps and materially participate in that property. What do I mean? To make it very simple, this is what I'm saying. If you are a full-time real estate professional, flipper, wholesaler, realtor, construction worker, you have your construction company, even appraiser sometimes in the qualified, those people can either buy short-term rental or long-term rental, do cost segregation on their property, and offset their $1 million in business income. That's what I'm saying, talking right now. That's the first group of people. One spouse has to qualify as a real estate professional. Now, let's talk about second group of people where both spouses have a W-2 job. Once you have a W-2 job, you can hardly qualify as a real estate professional. I'm not going to say you cannot, but if you have a full-time job, 2 spouse, a couple, or you're a single and you have W-2 job, you cannot qualify as a real estate professional status. Now, that's a whole different topic. We're not going to go there on this call. But let's say both of you have W-2 income. And someone was asking me earlier, Mr. Patel, he was saying, hey, I only have W-2 job. Can I use this to offset tax? Absolutely. That's where the short-term rental comes in. That's where this number 3 comes in. If you were to buy a short-term rental and then do cost segregation on the short-term rental, then you can offset up to $500,000 in W-2 income, which is pretty significant, right? If you make a $500,000, you probably pay around $180,000 in taxes. I have clients who make $500,000 in W-2, buys short-term rental, offsets entire $500,000, gets the refund of $180,000 from IRS. Happens every single day. I mean, I've done that, I think 50 times this year in last month when I'm finding individual tax return. Amazing. I mean, life-changing money.
Cool.
Hang on, Ashish. Yeah. I want to pause right there. Sure. We've talked on the show. Caeli and I have talked a lot about short-term rentals. I've carried on about Oahu quite a bit. And just because that's what I'm familiar with short-term rentals. So I just want to have you reemphasize, if you are not a full-time real estate agent or investor, and you cannot represent yourself as reps, there really isn't a better use for the cost segregation. You have to use a short-term rental approach to take.
Can
Is that
Larry, I'm sorry, I want to add in here. So my personal experience, okay, for real estate professional exemption through the IRS code, and you are the expert, you're the CPA, Ashish, but here is how it's been written and I understand it, and here's what I've done. So please, I'd like your take on this. So what is it? 750 hours a year of active participation, right? Now, I'm a W-2 in my business. I have a lot of properties, obviously, but I am a wage earner. I have been able to elect that and be able to prove without any shadow of a doubt that I'm spending at least, and if 750 hours a year sounds like a big number, right? But if you divide that by 365 days, it ends up being about 2 hours a day. And I'll share with you guys in my personal experience, I mean, even the time that we've been on this webinar here for 46 minutes, this counts per what my CPAs have told me over the years. This would count against that 750 a year. Or let's say, for example, I flew to Alabama for a weekend and did a tour of properties. I've got 36 hours that I could claim there. So please, if you could completely disprove me, straight W-2, I've claimed a real estate professional exemption myself because I feel like I can prove the 750.
Let me answer that. So the real estate professional status that we said, that's how everyone saves tax. The majority of full-time.
It removes the glass ceiling, right? That 150,
right?
It removes that.
Exactly, but you have to be very careful with this. This is the rule. Yes, you have to spend 750 hours in real estate business, which if you have 10 properties, anyone can meet that. I think if you manage them yourself, or even if you have a property manager, if you manage few properties yourself and have property managers on some of them, you can still combine and meet the hours. But the second prong of the test cannot be met. And I'm not gonna, you don't meet that, but you decide for yourself. The second test is this, right? I don't know if I have this in here, but second test is basically, says, I don't have it here. I'll show that in writing in the next few minutes. You have to spend as much hour that you spend in your other trader business in real estate. That's why W-2 employees don't qualify most of the time. Full-time job is 2,000 hours a year. Like that's normal 2,000 hours work, let's say 52 weeks. You have to spend 2,000 hours now in real estate, which gets you 90 hours work week for every single week, no Christmas, no Thanksgiving. So if someone can claim that, hey, I spend, especially if someone has a business, full-time business, and they work 15 hours a day in their business, and then claim real estate professional, that's not going to work. I've seen this. I mean, this is number one audited area, rep status. It's not a matter of time. You will get audited, and you need to prove that. And I get clients come crying to me saying, oh, IRS isn't asking me 500. I had a client who came back to me with a notice from IRS, $500,000 in back tax and penalties. Couldn't prove it because I think there is a stat that says 1 in every 360 audit in this reps gets in the favor of the taxpayer, because most of the people abuse this. That's why I'm telling you, rep status, if you can meet it, if you're a full-time real estate professional, I have doctors who let their wife quit their job so they can save $500,000 tax because she was making 50 grand as a teacher, right? You have to make some changes as career changes. So same thing with you. Let's say you have a spouse and he makes $100,000 and you make $1 million from business, then it might be worth him managing the property and qualifying as reps, because just tax savings might be $400,000 at the $1 million mark, right? So I don't know what your situation is. I haven't never dived into your situation, but if you spend at least 2,000 hours in your business or W-2 or whatever you call it, right, together, you have to spend exact same hours. It's not 750 hours.
Yeah,
it's 2,000 hours.
Yeah, I think maybe in my case, so yes, maybe I'm the exception to the rule because I am a lender focused on investors and in that investment space and constantly putting in that work that has been able to double. I think that's how I've gotten over it. And I've been audited and I won the argument.
Yeah.
And I had a lot of properties, right? So
exactly. Yeah.
2, 3, 4, 5 properties and your W-2, no way.
Yeah.
But to your point, okay, good. Anyway,
Okay, perfect. So this very good discussion, right? This is very relevant. We're saying, oh, you make fine, you can qualify as reps, then you move to short-term rental. But if you can qualify as reps, then you want to move. You don't need a short-term rental. You can buy short-term rental, but you don't need short-term rental. That's what I'm telling you here in this screen right here, right? And it's a lot of information, so I'm trying to hide this. If you just focus on this, if you want to use a full-time real estate, then you can buy both short-term and long-term, and it helps you with taxes. And I think Larry asked this: the cost segregation. When is beneficial to do for long-term and short-term? That's our next question, the last question actually. So here we're saying, if you're a full-time real estate professional, then doesn't matter what you buy, you meet the rules. We're not going over the rules, but you can buy both of these properties and get all the benefits we're talking about. But if you both of you as a W-2 employee, you cannot qualify as reps, which mostly you cannot, then your route is short-term rental. You buy $1 million property, you get the same benefit as a real estate professional, but it needs to be a short-term rental. Average of 7 days or less of tenant stay. Airbnb, Verbo, vacation rentals. That's what we're talking about, short-term rental. Now, let's say you're a business owner. Now, business owner, again, if you're a business owner and one of your spouse qualifies as, one of the spouse qualifies as a real estate professional, then you fall here. It's not a business owner. It falls here. If you're a wealthy businessman, your wife is a realtor, then you fall up here. Both of the properties qualify. When I say both of the properties, I'm talking about long-term rental, short-term rental, apartment building, storage units, RV park, long-term rental. It talks about everything else. But when I say business owner, I'm talking about someone who cannot qualify as a real estate professional. His spouse is also working in the business or doesn't want to do real estate. Then you also need to do short-term rental, which again is the same rule as being a W-2 employee. So for Mr. Patel, when you were asking me earlier, hey, I don't have a business income, doesn't matter. You are in the same bucket as a business owner. If you do short-term rental, you can still benefit from what we're talking about. Okay, I know it's a lot of information, but it takes time to digest this. But all you need to understand is here. What I'm trying to communicate is we understand the cost segregation, we understand the benefit. What should you be doing if you're under certain bucket? What kind of investment you can use to offset your taxes? Because end goal is to buy a good property and save taxes. I want everyone to still buy a good property, get a great lending with RGL, and then save taxes. That's the third wheel, right? So let's talk about this answer to Larry's question here. What I'm talking about here is, so if you don't qualify as reps, which most of the people cannot if you're not full-time, as we discussed, how can you leverage cost segregation? And this is how we do it. And I know it's going to get complicated, but I want to make sure you understand this concept. Yeah, most of the professionals don't even understand this. That's why real estate taxation is so complicated, right? Same 3 people, right? Let's talk about this. If one spouse was a full-time real estate professional, I said, hey, you can buy both long-term rental or short-term rental, and you need to, you'll qualify as, you get all the benefit. What I've written here is, hey, no need for short-term rental, assuming you will qualify as reps, need to be reps and materially participate. I'm gonna decode that. What are you saying? Oh, sorry, I thought someone was asking a question.
Nope, you're all good, Ashish.
Okay, so I know this is the last piece and it's most complicated, so I'm trying to build all this knowledge here. People ask me, okay, I don't have a short-term rental, I only have long-term rental, or I'm not a rep status. Can I use rep status to can I use cost segregation without rep status to benefit from my taxes? Yes, you can, if you do what I'm talking to you right now. If you're a full-time real estate, doesn't really matter. Okay, you can always use cost segregation on both of your properties. You're fine. So let's not talk about the first bucket. I'm going to hide this. Let's hide this because we don't care. This is where the meat of the conversation lies. You're a business owner. You're not a rep, or you're a W-2 employee like Mr. Patel, and you can qualify. So when is cost segregation helpful? Yes, it is helpful, even on long-term rental. This is like a contradictory information. I just told you, hey, if you don't have a short-term rental and if you're a W-2 employee, then you cannot really use cost segregation from your long-term rentals to save you taxes. And everyone knows that, if you know what I'm talking about. If you're a W-2 employee, if you're a doctor, a full-time job, you buy a long-term rental, you do cost segregation, the losses cannot offset your W-2 income. right? We talk about that. You need to be a real estate professional and all those things we talk about. Same thing with business owner. You're a full-time business owner, you make $1 million a year from a business. You go buy a long-term rental, doesn't help you with taxes at all. Meaning when I say it doesn't help you with taxes, I'm saying it cannot offset your W-2 or business income. It might offset your rental income that you're going to make from rental property, but it cannot offset your W-2 income. So what you need to do is this: synergize between short-term and long-term rental, because I get a lot of clients who already have 10 different long-term rentals and have never been used to never use the losses because it's limited under passive activity or loss rule. How can you release those? And when is the cost segregation on those long-term rental beneficial? Is if you buy a short-term rental. And let me explain this. It might go over your head. I want you to talk to your CPA if you are confused on this or you want to expand this, but this is how it works. If you have a short-term rental, you do cost segregation, you save $100,000 the first year in taxes. Very normal scenario. But the short-term rentals are extremely profitable. Meaning, for my example earlier, this Arizona client, my Arizona client makes $400,000 net from short-term rental. Now, if let's say he had 10 different long-term rentals or syndicated deals as LP interest, he can actually use the losses from those long-term rentals to offset his short-term rental income if you do some tweaking on the tax planning. Meaning, the long-term rentals cost segregation that could have never helped you before now can offset your short-term rental income because short-term rentals is going to give you income. It's not like long-term rentals, it's not going to break even. It's going to actually give you $200,000, $300,000, $50,000 net income, which is going to be highly taxed on your tax bracket. So now you can use the long-term rentals to offset them and save taxes. So that's what I'm trying to convey in this screen is this. It doesn't really. So if you ask me, hey, when is cost segregation helpful for me? If you synergize between, as a from investment strategy, both long-term and short-term, both long-term and short-term can help you save taxes with cost segregation. However, if you are not a rep status, then only short-term rental can help you save, with cost segregation and short-term rental go hand in hand. Long-term rental, it's worthless to do cost segregation. Okay, I'm not going to say worthless. I don't generally, if you don't have any other passive income, then the cost segregation is waste of money because the losses you harness gets limited. So I know it's a lot of information, guys. Maybe getting some questions can answer and can help this, clarify this. But before I jump into questions, I want to show something really, really fast. So this all ties together. Okay, this is what I'm trying. So let's say we all understand, what's going on. Okay, how to use cost segregation. Again, you guys are not expected to know this. It took me 10 years to figure this out. So that's why you got to pay your CPA, which you already have, and then make sure ask questions and ask them to explain this to you. Okay, but so don't worry about if you don't get this. All you need to understand this is buy property, save taxes. That's the end goal. Your CPA needs to make that happen. So let me give you a very quick example of like a fake client. And this happens every single day. And I know it's a lot of numbers. I don't care. Don't worry about all of things. Just look at the sum of the circles. It takes me 2 minutes to explain this to you. Let's say you're Tom and a married couple. Both of you, wife is wife and the spouse stays home. Tom makes $300,000 W-2 income, and not very complicated, right? And so you fall into this tax bracket, everything. Effective tax rate. You live in California. Your marginal tax rate, effective tax rate. Don't worry about this. All I'm saying is you make $300,000 a year. Now, what do you need to do? If let's say this is your first property, then you want to save taxes. I want you to focus on this number here. This is what I'm trying to convey here. I'm going to remove this, and I want you to look at this. If you do not do anything, okay, you're going to pay $74,000 in taxes. Very rough number, but state in tax, you're going to pay $4,000 in taxes. Now, what I'm telling you is, hey, you're a W-2 employee like Mr. Patel. You go and buy a short-term rental. This is a threshold. This is a purchase threshold. If you were to go and buy this $1.1 million property with 23% cost segregation, see how much taxes you can save. $56,000 just by buying this property and doing cost segregation at 23% cost segregation. Normally 22-30. That $56,000 refund from IRS just by buying this property. I know it's $1 million property, but you have to understand, you're not buying property to save taxes. We're buying property to have a passive income and, you know, make a lot of money. This $1 million property should net you $200,000 a year. That's given. You're going to make $200,000 extra cash flow from this property. But while doing so, boom, you're saving $56,000 in taxes, which could have never saved. Now think of, let's say this was a long-term rental and you bought, let's say Mr. Patel bought long-term rental. You can do cost segregation and everything, but it will not offset your taxable income. I know it's a lot of numbers. All I'm trying to tell you guys is, you know, I can run this for in a various scenario, how much money you make and how much you do. Again, that's not the purpose of this call. But all I'm trying to tell you is someone who makes $300,000 buys one short-term rental, Georgia mountains, California, Lake Tahoe, Florida, $1 million property, buy as a second house, put 10% down. I don't know. And to talk to tell you about this, he'll make it happen. 10% down, which you probably, put let's say $100,000 in this house. $56,000 comes back, so your down payment is only $63,000. So by putting $63,000 down, you bought $1 million property, and which gives you $200,000 net every single in cash flow. It cannot get any better than that. Again, I'm going to stop. I talked a lot. It's a lot of information. I get it. I'll take some questions so I can actually,
I
help
want
you guys
to
out.
thank you, Ash. This was great. I want to answer some questions from my perspective about when do we want to do this cost segregation, because my answer might be a little bit different than Ash's answer, but together, Ash, Bridge, you will come up with the answer. So remember, from an underwriting perspective, from a lending perspective, the more aggressive you're going to be over here with your cost segregation or your ability to take these losses and mitigate the amount of taxes that you ultimately pay, the more aggressive you're going to be here, the more difficult it's going to be on my side to qualify for a full income documentation loan. Remembering that that's not the only product that we have. If we decide that this particular year you've got extra incomes, or this is the year in which we want to max out the deductions and pay as little as possible in taxes, making that decision, but knowing if you want to qualify for more acquisitions or cash out refinances or whatever it might be, that the communication has to be in place to say, all right, this is the plan. I want to pay this much in taxes if I can. In doing so, this is what or how it impacts my ability to qualify. And if that means that I can't qualify using these products, here are my other products that are available to qualify for, and this is what the rates and terms should potentially look like, right? So the conversation just ends up being, which year in which do we want to apply this strategy, right? It's not going to be every year, obviously, but it needs to be measured so that we are setting you up to perform or to achieve what the goal is for the next year or the year after that. That conversation needs to be had so that together we can come up with that plan or strategy that accomplishes all of the variables that are part of your goal. So for me and my purpose, that's how we're going to decide when is the cost segregation strategy going to work. Well, it depends. Do you want to qualify for Fannie Freddie financing next year? Okay, maybe then this is not the year to do the cost seg, right? Maybe it's the following year, et cetera, et cetera. So I wanted to be, it was important that I communicated that to you guys, because that's from my angle or my perspective, how we want to handle that. Ash, how would you answer that from the tax perspective?
So I've seen a lot of people asking people, because one of our goals as an investor is to basically keep on buying property, obviously, and also save taxes, right? So there has to be a healthy balance. If you have a business and other information, other businesses where you just wipe out your income with expensing, a lot of your income, buying a laptop, vehicle, then that looks bad on your, because that would disqualify you for the loan. I mean, I do a lot of commercial loan right now, and I've worked with Caeli and a lot of this. But what I've understood from my lender on the commercial side and normal underwriting that Caeli has done is you add back depreciation, right? You on you're doing a cash flow for the property. Is that correct?
I'm sorry, say that again, Ash.
You add back the depreciation on
Correct.
the property, right? So
right, so the depreciation we get to have, yeah.
Yeah, so depreciation, this cost segregation is all depreciation. So your property might be netting $10,000 a year, but you can have a paper loss, depreciation loss with cost segregation of $200,000 to offset your W2 income, give you $550,000 refund, but you would still qualify for the loan with Caeli because depreciation gets added back under the normal underwriting rules. So you're gonna work with the Not all lenders do that. I mean, I have clients who come back to me and say, hey, I don't qualify for the loan because I had huge loss from depreciation. I'd send them to Caeli, and she makes it work. So all I'm saying is this is kind of win-win situation. You save taxes, it's a phantom loss, underwriting adds it back if you work with a good lender, and then you get to buy a new property and repeat this every single year, and then boom, you save, you keep it. And as you buy more property, as you get portfolio loans, things changes, obviously. Generally speaking, you do want to talk to your CPA and lender first before, making any decision, like Caeli said.
And to add on to that, it may come down to once we've done the calculations, right? Ash has done his work from the tax perspective. I take that draft tax return. You guys have heard me say this 1,000 times. Don't file the tax return until I've seen it. I'm going to take that data. I'm going to plug it into the pre-formulated worksheet. I'm going to see what the result is, and then I'll plug it into your profile that says, okay, this particular loss is going to create this in your debt to income ratio, or et cetera. The feedback then becomes, okay, Ash, okay, Donna, we're going to look at this together now, and I'm going to say, some of these losses, we may need to carry them forward. You may not be able to take the whole thing if you want to qualify for this year, but that's the conversation we'll have collectively. And now you guys are in a power position to make the informed decision, right? Without that collective discussion and conversation, you're going to make decisions that could otherwise preclude you from qualifying for the loan terms that you were expecting.
Terrific. So Ashish, Caeli, we have a bunch of questions. We've been on the call for an hour. So out of the respect for everyone's time, I'm going to try and moderate what I think might be a great set of questions, Ash, for you. And there were a couple of questions in here, Caeli, that we'll probably do after the call because they might be a little bit out of our scope. So the one of the questions that I thought might be interesting because it ties into what you were discussing was from Michael, where he talks about that he's made 125,000 W-2 job, and wife, who's a rep via their flipping business, made 153K on Schedule 1 for the total AGI of 268. So there were some personal taxes due of 27,700. The question is the idea of buying a property that might not cash flow just for the purpose of reducing taxes? Is that really tie into maybe some of the examples you were given?
This is such an important question. And you did not only pay $27,000 in taxes. You probably paid $280. You probably paid around $60,000, $70,000. What you're counting is when you file a tax return, you have to write a check for $27,000, but actual tax is way more because you're withholding from a W-2. Everything happens way before you think about it. Either way, I've never asked my client to buy a property just for tax saving. I don't do that. I should never say that to anyone, especially if your wife is already in real estate market, if she's already doing a rehab. You should be fine. You should be able to find a gem with wholesalers, with agents, and find a really good property that actually, at least at the minimum, breaks even. And not lost, but breaks even. For appreciation purpose, let's say you buy this property and you buy, $500,000 short-term rental or long-term rental, whatever works for you, because it's a rep status. You guys have rep status. Think about this. That $500,000 property is probably going to save you around $50,000 in taxes the first year. How long does a long-term rental takes you to give $50,000 in net cash flow on taxable money? 15 years. It takes you 15 years to make $50,000 from one property net cash flow over in 15 years. From my experience, again, there are some properties worse and better, but on average, you're buying this property, getting a $50,000 right back in your pocket by buying this property. So in that manner, yes, it makes sense to buy the property, but I also don't recommend just buying property for tax savings. That's one of the factors you need to look into it when you're analyzing the property. Hey, looks like my cash flow is $100 a month, but I'm saving $50,000 the first year. This is a win-win deal for me. I'm going to buy this. That's how you need to look at this. I guess there are a lot of email me. I'll give you all the analysis I have with really factors in all the tax savings and everything, so you can make the informed decision. But your question, your wife already qualifies as a real estate professional. Buy a property. Again, you can buy any property you want, but I don't want you to lose money every single month. I want you to make money but also save 50 grand while buying the property.
Excellent, Ash. Thank you very much. I think we're gonna try for one more question here, and this one comes to us from Teresa again. So the question is, her CPA recommends to do cost segregation because her income is over 150,000. So the way the question reads is, so I guess she's being told that she cannot apply passive income losses to active income. So there are some suspended passive losses that can be applied when the property gets sold to offset the gains. Do you see that strategy working also?
See, it's not a strategy. That's how the rule is. I mean, if you do nothing, that's where you sit. This is what I was saying earlier. If a normal W-2 employee, non-passive income, there's never active income. That's a wrong word. You have non-passive income, and then you buy a bunch of these properties and you have a bunch of suspended loss. This is what I was talking about. Do not even do cost segregation. If she's asking you to do cost segregation when your loss is going to get limited, that's a waste of money. This is an absolute waste of money. So unless you're going to buy a short-term rental, and that short-term rental going to produce your income going forward, and we do something called reverse engineering, meaning converting a short-term rental from non-passive status to passive status the next year, and then you can use all those losses from long-term rentals, and then you can do cost segregation. I know it's complicated.
That's where I get complicated. That's where I get stuck. That's where it starts.
It's very complicated, guys. I've never heard anyone do this strategy. I do this to my client because I understand real estate inside out. It's not even funny how many people miss this or can't even think about this. So talk to your CPA, and it's this for everyone. If you're not buying a short-term rental, and if you cannot qualify as reps, and if you don't have any other passive income, meaning you're not going to get a passive income from syndications when they sell the whole apartment, then there's no benefit of cost segregation whatsoever if you don't have any passive income, because losses just gets limited. However, if you want to turn around and let's say, market is going to cool down, I'm going to buy more property, focus on buying a short-term rental. Like I said, it not only gives you a huge tax savings the first year you buy this, because you're going to get, you can offset your entire income with short-term rental, get $180,000 back, let's say, from tax refund. And starting next year, when you make $200,000 net from the short-term rental, all the suspended passive losses from long-term rentals now can offset your short-term rental income going forward. So it doesn't get suspended. I know it's a complicated strategy. You need to work with qualified or your CPA to implement this. And
you need to work with Ash and his team is what you need to do.
Hey, Terry, I'm so generous with my time. I have people reach out to me every single day, even though I don't work with them. I email them out. I help them out. I don't care. Email me out. I'll help you out. I do want to answer one more question that I'm seeing again and again about this syndication that you guys do. Okay, this is very important. Everyone does this wrong. You got to work with the real estate CPA to understand this, and even some of the real estate CPA I've seen does this wrong. I'm not going to talk about cost segregation or anything else. For you to use the losses from your LP interest in syndications, okay? I'm a syndicator myself. You invest with me, I give you 100,000 loss on one of the commercial property you invest with me. You cannot use that loss unless two things happen. First thing is you need to qualify as reps, and you need to have 500 hours in your long-term rentals. Ignore the short-term rentals, doesn't count. If you spend 500 hours in your long-term rentals and you have an LP interest, you can lump them together and then use a loss. That's the first way. Second way is exactly what I'm talking about, short-term rental. If you have a short-term rental and you could convert that to passive after the first year of non-passive treatment, then you can use all the syndicated loss to offset your short-term rental income. This might go over your head. You got to work with professionals, by the way. So the thing is, you can use it if you plan your tax correctly.
So Ash, Caeli, go ahead. I'm sure you want to add something.
Well, I may be saying what you're about to say. I'd like you to go ahead for everybody, Ash, give them all your contact information. We're going to have it in the community as well, you guys. But I thought just, for now, if anybody wants to write this down, or if you have a screen that you can share that has all your contact information, Ash, that would be fine too.
Yeah, we'll go ahead and we'll post that out afterwards. I just want to, again, before we lose too many people, because we are over that hour mark, I wanted to tack on to a question David asked, because it was on my mind, Caeli. We're going to be talking probably in the next 40 days or so, or maybe next 30 days, to all of our clients to recommend that they really start to look at year-end purchases, right? For 2022, we're coming up towards the end of the year. And the question that's going to be important on everyone's mind is, at least from this meeting, is should I go out before the end of the year? And if I were to purchase a short-term rental for this year, can I take advantage of this strategy? And then as part B to that question for you, Ashish, is David's question. What happens if that short-term rental becomes a long-term rental afterwards? If you can handle those two.
Yeah. Very good questions. You can buy a property, close on a property December 25th, rent out 2 times, and you can get the full year of benefit. So yes, and that was, I guess I wanted to talk about this and forgot about this. Even for 2021, if you guys have not filed your 2021 return, and you've already had the short-term rentals and other property, you could do cost segregation. It might be worth waiting it rather than amending it, doing a cost segregation and layering in the cost segregation. That's the first issue. Second issue is that you already filed it. You don't want to do that in 2021. 2022, you have 3 months to find a new property that is a short-term or long-term and do this, what we're talking about. Even if you buy the property in December 31st, not 30, let's say December 25th, and actually rent it out or have advertised for rent, then you'll be fine. You can still use this. Next part of that is what happens if you change it to a long-term rental. You got to be careful. It's not against the rule. There's no IRS. There's no rule about this. But you don't want to be abusive, right? Let's say, I have clients, like I said, saved $300,000, $350,000 with various real estate. Let's say this was one of his strategy. He used this short-term rental, bought it December 15, rented out 3 times in Airbnb. Next year, converted it to long-term rental. Looks very sketchy. Again, not illegal, sketchy. Can you do that? Yes, you can do that under this circumstance. If the city comes back to you and shuts down your Airbnb and you have no other issues and you're required by law to convert to long-term rental, that makes sense. Your HOA restricts it, makes sense. But if you're just doing that just because you wanted to save the tax in last year and then convert to long-term rental, it's gonna, I don't recommend that. Again, if you want to take a risk, it's up to you, but I don't recommend that.
Thank you, Ash. I think we're trying to wrap, right, Larry? We're way over, which I kind of expected. This was so cool.
That's a big topic. Yeah,
I'm thinking we'll probably take a poll here, but I'm thinking we'll have you back, Ash, to just maybe do a Q&A and just talk about some other tactical things. I would just wanted to say one thing when we're talking about year-end planning, guys. This is something that will continue, Larry and I will continue to beat the drums on. That's the busiest time of year for us. When the rest of the industry is on skeleton crews, they're on vacation. It's the busiest possible time of the year for Ridge. So October, November, December, which is now basically, if you have plans to secure financing by year end for these tax purposes or anything else for that matter, I need you to get your applications in quickly, get ahead of the game because turn times are going to be extended. Like I said, you got skeleton crews. We've got holidays where everybody's off, appraisers are slower. So if that's part of your strategy for the year, I'm strongly going to encourage you to get everything going and your ducks in a row now so that we can take advantage and we're not waiting until the 11th hour when, it happens every year. People come in on, the 10th of December. Oh, hey, I got to close this by the 31st. You wish. It's unlikely to happen. So just keep that in mind. I wanted to share that with you guys. So cool that you were here and everybody that got to stay on and listen to all of this. I'm so excited that we got to share this with you. Larry, closing statements. We're out next week, right? We're not, we don't have
two big things. So A, we are going to work feverishly to get this replay up for everyone because there wasn't a moment to miss, Ashish. So thank you very much for coming. You risked literally life and limb to be here instead of racing out for the storm. So please be safe. Anybody who's in Florida, everybody's feedback is phenomenal. There are a ton of questions. Some of them were really personal, specific. So for anybody who asked a question that didn't get an answer, we're going to make sure that you do. We're going to make sure that we structure it in a way to be helpful for everyone. And yeah, I couldn't think of a better way to move forward. And as more questions come up, Ashish, I think you piqued my interest with just the idea of I need to get my ass in gear and get a short-term rental here before the end of the year if I want to take advantage of that strategy. So thank you for that. And for everyone else, like Caeli said, if you have questions about and you think you're going to be needing a mortgage here before the end of the year, please give Ridge Lending a phone call at 855-74-RIDGE. or email to info@ridgelending.com. You can go right on the website and apply ahead of time and definitely get stuff together. So we, as Caeli said, we are out next week. We are actually going to miss our first week since February, Caeli, ever. It's
Wow.
a big one. So we're going to be on
We could
opposite.
replay this.
We could theoretically, but now we'll probably just let people build up some anxiety about getting the next show. So the next show is going to be on October 11th. We'll be back here live. And Caeli Ridge, thank you as always. And Ashish Acharya, thank you very much. We really appreciate
Thanks,
you
guys.
coming. And
Thanks for
everybody,
being here.
Guys.
have a great rest of your day. And thanks for participating. Take care.
Bye,
everybody.
gang.
Thank you, guys.